Equity markets have been doing incredibly well lately.
Yes.
What's motivating that? Is it the numbers we saw from China? Is it something else that we think a trade deal's near?
So, I think when it comes to trade, there's a lot in the price. I think the markets have basically priced in some sort of resolution to trade. I think what's been moving markets more recently has obviously been the dovish shift at the Federal Reserve last month. But more importantly, some signs that there are green shoots emerging with respect to global growth. The China PMIs looked a little bit better. The European manufacturing PMIs still don't look great, but the services side of the equation is improving. The U.S. numbers are getting a little bit better. Retail sales, durable goods, right, all showing some signs of life. And I think when you look at where the first quarter could shake out and where we may be headed for the rest of the year, things just aren't looking quite as dour as they did back in December.
Deutsche Bank downgraded Caterpillar today, and they looked at three different things. They said it was the oversaturation of machinery here in the United States, but they also said Europe they think is going to be worse than expected. And they said China, the slowdown there has been particularly big. Is that a call that is prescient of things to come, or is it backward looking in terms of Europe and China just based on what we're hearing this week? That's what I'm trying to figure out. If you look at these green shoots, how much can you really think, okay, these are going to fully bloom?
I think it's a little bit backward looking, and I think importantly, to kind of go back to my earlier comments, tempered enthusiasm is probably what I would recommend here. I mean, this is still a global economy which has a number of structural issues when you look at productivity and demographics, so there's only so fast that we really can grow without overheating. But I also think what's going on is companies are very nervous about what's going to happen with earnings this year. There's still a lot of uncertainty out there, and so
companies and investors too. Probably.
And investors too. But if you put the bar on the ground, it's much easier to step over as opposed to setting it higher and then disappointing over the course of 2019. So I think there might be a little bit of that going on there. In general, we're kind of in a more glass half full mode with respect to global growth this year.
Kevin, what's your take on the economy both here and abroad, especially when we keep watching yields under incredible pressure?
We're coming off, David and I were talking about this, coming off the best quarter for fixed income we've had in 2 years. And it all started with the Fed in December and has carried on into last month as well. Everyone concedes that globally the economies are slowing. We won't be the exception in this country, but it's not as bad as everybody thinks. So it's always, for bonds, it's always been an inflation story or a lack thereof, and will continue to be so. So we saw spreads go out and spreads contract quite a bit. The only risks that we see are a geo risk of some kind. And the trade deal is it could have some mild impact. I don't think it's going to be robust enough to generate inflation and get the Fed back in the game. But so we're extending durations in here versus being worried about some of those risks.
You have some particular ideas, too, when it comes to trying to lower your tax bill. It's tax season, and people in the SALT states in particularly are probably looking at this and thinking, oh, my gosh, what do I do?
Yeah, there aren't many plays left for anyone that's doing their taxes or done their taxes. You're capped right away at $10,000. And so what are you going to do to try and offset that? And there's been a tremendous influx of money into municipal bonds because that's one of the few things that you can earn interest tax-free and help you offset that. So big surges in money going into bonds, whether it's ETFs or individual bonds or funds, which has pushed spreads out a little bit, but prices up quite a bit since probably the best year in 5 years.
David, you think we're going to hit new highs? I mean, it sounds like you think we're continuing higher from here.
I think intra-year we will hit a new high, but I think last time I was on we were talking about this. I think where we finish the year is probably somewhere around where we are today. When I think about the behavior and the performance of the markets over the past couple of months, it's really been driven by a re-rating in valuations. To your point about earnings expectations have actually declined during this period of time.
But that makes it a lot easier to beat.
Were you saying we're going to end the year where we are right now when we were at 2,700 on the S&P? How long have you been saying we're going to end the year where, because it's been going up?
So we talked about this the other week, Joe. 28 to 2,900, I think, is a fair range for the S&P 500. I think we could easily get to 3,000 if we have a trade deal, Fed stays on hold, global growth gets a little bit better.
Could we easily get to 2,400?
Not as easily, okay. I don't think. I think that there's more support on the valuation side than there's been in some time, given the re-rating that we saw last year. What I would say, though, is that I think we're going to see a little bit of a blow-off phase.
Because we're at 2,867, and your latest range is 2,800 to 2,900.
Yep. And that's
pretty safe. I mean, but I want to hear it before it happens. So we're not going to 3,000 to 3,100.
No, I think we will go to 3,000. Right, but I think we will then come back down because I don't think A, multiples can be much higher than 16.5, and I don't think B, earnings are going to come through much higher than $170 a share. Right. If you multiply those two numbers together, it's kind of where you shake out.